Hey, hello, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, weekly stock market analysis show, where we basically look at the technical charts and try to understand and learn what exactly happened during the previous week in the market, and then try to learn something from it, and then that's what we do. So we'll also plan for better trades, trade opportunities that exist in the coming week. And this is for the week that's starting from August 7th, tomorrow, Monday, 2023. So let's get to see the basic both side view on the weekly charts, and then we'll go ahead. Here we have left side the Nifty, and right side you have the Banknifty charts. You can clearly see the flag pattern, the dotted flag part on both indices. You have a cup and handle is also a flag from the previous low, and then you can see a breakout that's happening. There is also a cup and handle on both, clearly visible with the dotted lines showing the handle, and then a breakout. A rounding pattern can be seen, which is also breakout. So it is a pure breakout rally that's still in play. Nothing much has happened. It's a small retracement that has happened, and market seems to have showing longer wicks, indicating some bounce up that has happened from the support zones. So it could be assumed that it's a normal retracement that happened after multiple all-time highs were made, especially Nifty went as far as very close to the 20,000 levels up in 2023. So that's a bird's eye view. We can clearly see the red indicating the 20 exponential moving average on the weekly, right, on both time frames, and then you have 50 exponential moving average and 100 exponential moving average. From there you have a lot of supports, and these are the weekly. The momentum is intact. This is another view. This is the weekly charts with a parallel trend line, parallel channel, whatever we call. Right. It has hit the top of the channel and then retraced. Nifty has not hit the top of the channel before midway. It retraced. And this also has two Fibonacci. One is the Fibonacci retracement levels indicated by where all it can stop, take support, where all it may find supports are all seen here. While from the previous swing low, you have another Fibonacci extension. That has it is also shown on the for the left. You can see that 78.61. That's Fibonacci extension. So that shows that the extension has broken out on the Nifty on more than 61%, and then went as far as 78%, and then retraced. Fibonacci 60 above is it's extreme breakout that already happened in Nifty, but in Bank Nifty you can see that it has not gone beyond the 61.8 Fibonacci extension yet. That's another. So this is another view of the weekly, and that was another view of the weekly, and this is a daily view. What has happened is a consolidation on the daily charts, a breakout, and then within a parallel channel a retracement. Here within a rectangular pattern consolidation, taking support at Fibonacci 23 on daily, and you can see the consolidation, and also similar consolidation also happened earlier in the Bank Nifty also. So these are all different views to understand where we are. In the short term, this is where we are. We are at the support. We have retraced after hitting an all-time high. Here we are in the midway of a rally. We broke out, definitely. Bank Nifty has more scope to break out here in the parallel channel in the top. Some retracement consolidation could take us to the bottom of the channel probably, and then up again. This is another view. So all this view should be in your mind. Now let's get to see the candlestick patterns. We can clearly see that this is not a wide body, but a long wicks on both sides, which is more similar to a spinning top on the top. So weekly small body spinning top, long wick size, mounts up, but definitely bearish for the second week. Bank Nifty, it's more wider, but still again the wick size indicates a bounce up, supports down there, and it still clearly indicates that there is a possible certain supports when the change in polarity. Bounce could happen. That means the previous resistance zone is now acting as support, and the bounce happens from here. So it's clearly visible on this chart. But clearly 2 weeks of decent, good, healthy retracement has happened in both the indices. Can be seen. That's what the candlesticks are indicating. The daily candlesticks are showing that Friday had a bounce up. Friday had a bounce up move, green candles, but on the Bank Nifty, that green, there is selling pressure as well as there is buying pressure. There is a big bull bear fight that has happened, indicating that this is a small body index is still there, kind of a spinning top, but not on the top of the rally, so you don't need to worry. But index is very much indicating Bank Nifty candlestick. But otherwise, Friday has shown some kind of up move, some kind of support confirmation. That is visible in the daily charts. This is another view of the Bollinger Bands. Bollinger Bands indicate how volatile the market is in a way. It can be used for that as well. Market right now is sideways, can very clearly be visible from the daily charts of Nifty and the Bank Nifty. Right? You can clearly see that the expansion is not happening. It is still under contraction and the sideways. So that indicates that within this band, price may move up, down, up, down. We never know. Until expansion is confirmed and price breaks out of this. Similar to the downside, until expansion happens downside and breaks out of this, until then it's sideways market. So to know whether the market is trending or sideways, Bollinger Bands can be used. To know how volatile it is, what is the range of the volatility that could happen. Here the range is very visible. We don't need to know anything. Market could oscillate between 19,000 and 20,000. 19,250 and 20,000. Anything beyond that is a breakout. Right now it's consolidating. It's not trending. This is clear, very much clear on the Bank Nifty also, right? But Bank Nifty is more formed to expand because it almost went to the expansion mode and then bounced up on Friday. So that's how we study the market. Now comes the different support and resistance level. So exponential moving average of 20 is breached, and price right now in the Nifty is resisting below that. So the first hindrance will be clearing that and having a close above on that exponential moving average. Until then, we have short-term bearishness that could clown as seen in the daily charts. So the first resistance will be the exponential moving average of 19,541. Then we have 19,595. That's near to 600 rounding number. And then the resistance at 19,867, and then all-time highs in 20,000 rounding number, big rounding number levels. So downside, the supports can be seen at the previous swing low at 19,300. It's a very good support. Market has bounced from there, and after that you have the 50 exponential moving average support on the daily. That could be seen at 19,174. Before that, you have the gap supports coming at 19,200 also. And once there is gap is also breached, then you have 19,000 rounding number and 20,011, where previous swing low is also there. So 100 EMA comes in at 18,737. So 18,887. 18,777, these are all interim supports before that. So that's how the support resistance act on the Nifty. Bank Nifty, similarly, you can see that 20 exponential move average, it's still up there. The first resistance, that is at 45,230. Market has to have a green close above that to turn bullish again. After that, resistance will be 45,655, and then 46,000 rounding number, then 46,369, and then 46,500 rounding number, and the previous swing high. So then 47,000 and no rounding number, like that it goes. Downside, the supports right now it has bounced up after taking a support of the 50 exponential moving average at 44,650, right? And then 44,500 zone, 44,154, 44 rounding number, 43,756 is 100 exponential moving average. That also in the Bank Nifty can have good supports, right? So yeah, there is also a parallel channel that's in confluence with the 50 exponential moving average in the previous swing low. So that's this zone where the Nifty is right now is a heavy support zone, and then a bounce up has already happened on Friday, and then it has to sustain and close above the 20 exponential moving average first. Those are the support resistance levels on the Bank Nifty that you can see. Moving ahead, let's study the momentum and the trend. Left side we have the indices on the weekly charts, right side you have the daily charts. So you can clearly see that the momentum in the medium term, absolutely nothing has happened. Although it has dipped, it's still in the bull zones, while market has slipped into the sideways zone with respect to the momentum, clearly seen on both indices, and it has slipped even more deeper in the Bank Nifty, but it has beautifully taken a support at the RSI 40 and then bounced. That's very bullish. That indicates that it's not dead. Market has taken its support of the momentum and then bounced up. Nifty has bounced up also, but even before the support has come, it has turned But overall, the momentum has slipped from the bull zones into the sideways zone and remains in the short term. But medium term, it's in back to the bull zones, but there's a slip in the momentum that is happening for sure on both the dice the last 2 weeks. Natural. That's what I see there. Now, trend indicator, we are using ADX. ADX is having also crossed out to the bear zones. It's DMI negative. It's a mistake here. It's let me correct it right away. DMI negative zones. So ADX has it's a trend indicator. It indicates a trend. You study the trend with using that. So the directional movement is it turned bearish on the short term, just like the momentum was slipped in the sideways. It's no short term cross over to the bear zones, but and it's and the weekly time frames trend continues to be bullish. But how do you exactly read this? Is like this, right? The trend indicator ADX says that Nifty is bearish, but the bearishness is reducing. And the higher time frames, the weekly charts, Nifty is bullish, but flat bullish, right? But Banknifty, you see, it's bearishness, and that bearishness is increasing in the case of Banknifty on the short term, and the more medium term, weekly is bullish, remains bullish just like the Nifty, but it is falling. That bullishness. The bullishness is reducing, bearishness is increasing. So Banknifty is seen showing more bearish trends than the Nifty is very evident from the study. That's how you analyze the ADX indicator, right? So ADX indicator is what is seen in the bottom part. So it has three things: DMI positive, negative, and green, which shows the strength of the trend. So if you're not aware of this technical analysis of the ADX, we have check technical analysis playlist. I have a lot of videos there. You can go there and then understand how the momentum and the trend indicators is used to understand the market easily. It's very easy, right? Here, when I'm doing the weekly charts, I assume that you all know that, already watched that and studied and understood that. That's the assumption that I have. That's why I normally don't cover that. That's about the momentum and the trend, and move on to understand more about the volatility and the opportunity analysis. The India VIX is the volatility indicator. It's fear and greed index. India VIX has done a big thing. 18% of spike happened this week. That's the retracement that happened, and then it settled at around 4.4%, week to week basis, and still below the 10.57 is historic low levels. So it continues in the low VIX, with granular intraday volatility, but VIX is at historic low levels. Spiking between 10 and 12 is what is happening since more than 1 month or 2 months, right? That's always when it falls below the 11, you have the danger of the spike up can be ferocious. That's because it's historic low 10. Then it goes below the 10. So 10.13 or something it came last time. So last week in short, market trace and market fall, reverse from the top, and VIX behaved normally, unlike the previous week. VIX also spiked up, but VIX spiked up big time, and then by Friday it cooled off. So 4.4% of spike in VIX, but still in the low voltage range. Open interest data is what we understand. OI is open interest analysis on the futures. Indicates that it is bullishness there. Right? The last build up in the Friday futures OI is saying it's long build up and short covering on the Banknifty futures OI. So options OI is bullish, but not bullish enough. Above 1 it should have been great, but it's still at 0.87 and 0.78 OI. It's not that great. That's the PCR we're talking about. Put call ratio is not bullish enough, but more biased towards the bullishness. So options OI and futures OI is indicating some kind of bullishness, underlying bullishness is there from the Friday moves after the retracement, right? So let's study the levels. So the highest support can be seen at Nifty. The option call writers, put writers have seen have written puts at 19,400, and the second highest is 19,500. The highest resistance while it is seen at 19,600 and then 20,000. So Banknifty 44,000 is where the maximum put writing is there. Call writing maximum is at 45,000. So 40,000 is the same place where the second highest support is seen, and 47,000 is where the second highest resistance is seen. So the market is likely to move between 44,500 and 45,000. Very narrow range. 19,400 and 19,600. Very narrow range of 200 points. That's how the betting is happened by the option writers. They put on calls in Nifty and Banknifty. So yeah, so understand These support levels are shown by the open interest, where the option writers have bettered, and then correlate this with the support resistance levels in the charts that we have seen, and then you would be able to come to a conclusion of where the markets are likely to take support, where the markets can face the heat of resistance and all that. Next, as we move on, the different industry sectors is what we watch. The IT sector is 3.3% up, and wide range bearish weekly candle is what is. Oh, that's not true. That's wrong. Wide range probably bullish. Right? It's a bullish weekly candle that we are seeing. So IT had made. Let's see the chart. See, IT had made a big comeback after a wide range bearish move that happened last week. It come back, it bounced, it took the support and bounced, but still it's in the consolidation zone. So in short, last week what happened is we did not have had a great impact due to the pullback the previous week on across the sectors, but this week we have slight impact because the momentum is what we studied. So the momentum has slipped from both time frames being bullish. So that scenario is now there only in the metal sector and the pharma sector. The metal and the pharma did well, is doing well overall from the momentum perspective. It's in the bullish zones in both time frames, and it's rising momentum. So you could still take positions there, but otherwise the rest of the sectors, other than the leading sectors, are all FMCG, realty, auto. These were driving. They all slipped in the short term, the sideways. All the medium term momentum is good enough. So that's the impact. Across the sector, sideways move has happened in line with what the index is also showing. So auto sector slipped in sideways, and FMCG slipped in sideways, and realty also slipped in the sideways. Right? On the short term, we're talking about FMCG, auto, IT, reality of the mode side. So all these sectors that's remaining there in bullish zones in both time frames is metal and pharma. And pharma did really well last week. It's 1.85% of pharma. So what got hit last week was reality 4.3% up. And previous week it just bounced at nearly 5%. Same thing. And our gains were given up to 4.3% down. Reality, FMC 1.7% down. Pharma 1.8% up. Auto 1.3% down. 3.3% up. So IT did a comeback. Pharma is breaking out. Metal is just indecisive, dodgy. And what retraced along with the index is the auto, FMCG, and reality. Right? Pharma IT is holding up. That's clearly visible in this chart. Right? You have a consolidating sideways IT index trying to break out and move to the bull zones, but facing resistance here there. You have the metal index, which is already in the bullish zones, but at a resistance in all-time high levels now. You have the auto index, which is met a resistance in the last 3 weeks. It's consolidating after having hit all-time highs. Bullish momentum maintains in the medium term, but slight slip into the short-term momentum. And pharma is breaking out like hell. It's also a cup pattern breakout also. So pharma is breaking out hell, and extreme bullishness is what you see there. Some pullbacks may come in coming week. FMCG is also on the top of the channel, met the resistance all-time highs and then retraced last 2 weeks, but momentum is still bullish with the divergence also there, which indicates that you could take support somewhere and then again further move up. Reality is also in the bull zones. There's bullish momentum divergence possibility is there. Wide range bearish candle is what last week after having made all-time highs, resistance zones. It's a cup pattern, and any breakout from here would be huge, right? So it's a previous resistance zone, exactly where it has shown met and reversed. So it does not indicate weakness at all on FMCG, realty, pharma, auto, and metal. It's only the IT that is showing. So all across the sector, it's not that bad when you look at, it's not at all bad. It's not at all bad with respect to momentum and the trend, when it comes to the medium-term charts. But short-term hitbacks has happened across the sector, like we discussed earlier. Now, next we study the industry heavyweights. The heavyweight stocks that contribute maximum to the index. HDFC Bank continues to be the sideways zigzagging with that range in the bear zones, right? Unable to get a climb in the bull zones. And a breakout from 1757 is yet to happen. A lot of things are happening, but eventually it is going to happen. HDFC is a fundamentally strong company. Reliance is zigzagging since long within that channel and then unable to break out of that. and that breakout could be rewarding if it sustains. But momentum is in the bull zones. I see as a again momentum is in the bull zones. After having all-time highs, 2 weeks of retracement, momentum is in the bull zones and having potential to take support as the RSI 60 and then bounce up from here. An ascending wedge pattern continues. Right? It could consolidate. It had already made multiple cup and handle breakouts one after the other. No, that's it. Bullish momentum reliance in ICICI Bank. Now it's holding the market. Infosys, as we can see, that's trying to get into that rectangular box from where it had fallen off several months back. Right? Momentum is sideways, and then let's like the index, the IT heavyweight Infosys and TCS also is in the sideways and trying to maintain its position on the bullish zones. TCS had given an indication of the breakout. It continues that. TCS did a good move last week. If you also did a good move, the only thing is it cannot sustain on that bull zones for more time on the medium term. That's what it means. Kodak Bank, as usual, it is moving in that range bound and then looks like it's heading down. Momentum remains sideways. Now, ITC is where the profit booking has happened. Absolute profit booking after having broken out of a very long rounding cup and handle formations and breakout. Crazy breakouts happened, and then now it is tipped the momentum price. It's retraced last 2 weeks, and then it could take a support at RSI 60, but momentum on the other side indicates it's still comfortably in the bull zones, and then this divergence potential is there where it can settle somewhere, and then another breakout towards 500 plus could happen. So, right, so ITC and ICICI Bank and Reliance absolutely bullish. HDFC Bank, IT stocks, TCS, Nifty and Kodak remain sideways. Is what the most contributing heavyweights of the index is telling us. Now, how did the institutions participate last week? So we have been we in the sense the bulls have been so very happy that the foreign money is was falling in crazily. Right? Billions of dollars of money has come in when the Fyers bought from the markets for billions in the last multiple weeks, and now we have 2 consecutive weeks with the sellers, net sellers. Not too much, but 3,500 crores. Last week also 3,000 crores of selling has happened, but DS are taking this opportunity to buy in, and 5,617 crores of buying. So net institutional support is there, but 2 consecutive weeks of selling from foreign institutions is a bit of a worry for the market, especially when it is reversing from the top, from the very, very top. Right? It's a word of caution. Another study that we do is global markets, global commodities, the currencies and mother market US indices. Right. Let's start with the currencies. Dollar index has closed with 0.29, 0.29% up. It's 102 levels. Right. Down more 15% had happened. So here we have the left side, you have the chart. So it's a cup and handle formation. It is attempting to break out of that. It had retraced 15% and now it's attempting 0.5% up move, less than 0.5% up move. Momentum is still in the sideways, climbing back in sideways after that down move. So looks like dollar is attempt to break out of that. The USD INR currency pair, after rupee having gains a little bit in previous weeks, having been at the bottom of the wedge, looks like once again it is climbing towards the top of the wedge. And rupee has become even more weaker last week. That's 0.5% of up move that has happened. The USD INR currency pair, rupee remaining weak, and dollar is also spiking up. Crude is 2.5% up and it's 82.6. There is some warning signal that's coming, but its momentum is still sideways and then within the channel. As long as it does not break out to this 90 above, rolls out of this channel, it should be fine. It's still a relief, you can say, but there is some bullish moves that is happening there. You have to be cautious about that. Having crude oil and rising, and a dollar rising up, causing weak rupee is trouble for the economy assets. Although some oil marketing companies may benefit from that. Right side you have the gold, which is where the safe haven money lands up. Gold is not ready to fall down. It's a cup and handle formation, trying to break out but facing the resistance. unable to take out the all-time high levels of 2075 nearby zones. But it's not ready to move down before giving another try. Momentum is otherwise dipping in the sideways zones, no, but price remaining on the top still. Okay. But yeah, that's it. That's how come down. US markets, and if you see the indices, Dow Jones is looks like it was breaking out of the trend line as a descending wedge. But if you shift the trend line to join from the top, you can see that still it's at resistance and red pullback. After having climbed in the momentum bullishness is what you see there on the Dow Jones. And Nasdaq also is similar patterns of red day on S&P 500, Nasdaq, and Dow Jones. Right? How much is that cut? It's 2% S&P, 3% on Nasdaq, 1% on Dow Jones. So a red day. Resistance heat is falling on the US indices. Although the momentum is in bull zones, it seems like it's attempting to break out from that zone on the top of the descending wedge. Alright, we got to keep a close watch on what the US markets are going to do. And there is also a Fed event that may be coming this week, upcoming week. The Fed new interest rates news will come in, and then markets could turn volatile. And if the market and if this reversal is continuing and then supports are breaching, then we have and if that's happening very strong, then our markets obviously could, not all this, but could also show the impact of the threat in our markets as well. That's it. That's about the study. And then we have stock picks, two stock picks. Hindustan Copper weekly charts that we're seeing. It's a parallel channel, also can be called as a flag on the weekly, and it's a breakout confirmed. Actually should have entered in the last week itself. It was already confirmed. It's a bit too late, but still you have potential. A lot of moves that could happen to 195 all-time highs. Momentum is absolutely bullish. Look at the volumes. It's crazy. Some kind of fundamental news has come in. This kind of volumes are crazy. Now that it is smooth, such big, some pullbacks could come in. If you get that, then it's the ideal entry. Even if you don't get that, if the price moves above the moment they are the top of the previous scan, you can enter and then you can go for long, short swing trades. Now the stock price is the temporary reality. The reality sector is also at the top. Volumes good. Momentum is trending up. Price ADX also indicating a trend up. Momentum and trend indicators up. It's a parallel channel. A lot of space towards the top of the channel, and that could give long swing trades up till the top of the channel. Right, because it's already confirmed from the rectangle pattern, and channel also indicates it is moving up. Right, so it's bullish momentum trend, price pattern all bullish on temporary reality. Hindustan Copper, both long calls. Now, this is Nifty actionable, Nifty weekly options strategy. It's double diagonal current spread that we have on right now. It's not in the mid. I really should have taken it at when the price is 9400. This can be taken on Fridays. This ideally should need to be taken on Fridays. So probably profit is good in the very good range of 92.45 and 97.53. Right, rolling up and rolling down can be done as adjustments in case it breaches that levels. The market is likely to remain sideways, so it is less likely that it breaches out of this zone. And also the VIX is very low, so a spike in VIX could give hedges. Also can spike up and then keep it more profit, but don't keep it to the last day. Exit on Wednesday latest, or whenever you get 1 or 2% come out of it, and every week you repeat that, and consistently you can gain. Probability of profit range absolutely good, and RiskReward may not be that great, but it's still consistently money making if you exit at 1-2% every week before they expire. Right, so double diagonal calendar spread again. That's a fully risk defined, low capital requirements, a portion size as per your appetite, risk appetite, and capital size. Right. Let's just wrap up. So this week's nothing but another further continuation of retracement and consolidation after having reversed from the top after meeting the resistance. A few inches away, the big rounding number of 20,000. Right, and 20% of rally is what we saw, and then it's the retracement. It's quite normal, and that happened. The 20% move happened after breakout from a flag and cup and handle and rounding patterns and all that we have seen already in the charts. So retracement, consolidation, reversals is what is going on. So momentum has slipped, trend has slipped. Why is not bullish enough? If I is turning sellers for 2 weeks consecutive, Bollinger Bands are contracting and showing sideways. News markets and rent, at resistance, and all this gives hope for the views that more sell-off could come in, more retracement, more pullback, more consolidation. All this is possible. But what's in favor of the bulls? Short covering, long build-up on the future soy on Friday, low wicks, still at low wicks. Medium-term momentum, potential divergence is seen on the Nifty. Right. And that's bullish for divergence that we already seen earlier. If you're not seen that, just scroll back and see that section of the video. Trend is in the bull zones for CIP changing proactive polls. We'll discuss about that. All this gives hope for the bulls of the market. They continue the trajectory after some retracement. Right? So big rounding numbers, as I said, profit booking zones. It's difficult to take out those zones just like that. You have to be cautious. Market may play all kinds of things, and then it'll be choppy, volatile, going up, down. All the drama will be done before one day when we least expect we'll take out that big rounding number of 20,000 also. It could happen. So that's more likely that maybe, or there is also a possibility that that's it. Market is rallied up. Now it's time for long retracements, pullbacks. Either of this could happen, but that's why we have the support resistance zones that we are watching. But as of for the next week, the views might be bearish with neutral sideways bias is what my view is. Now, global recession fears, Fed interest strike, war, all these uncertainties are still, even though the VIX is strong. So any of this turns bad, the VIX could spike them and then things go out of hand. Right? So gold is spiking up, dollar is also spiking up, rupees weak. These are worries, concern still prevails in the market. All we have to look at is portion size and look at the levels of support and resistances, which may or may not, be, may or may not be followed by the market. Market will go its own way, but we can only think of probabilities of resistance, probabilities of supports, that's all, and then portion size accordingly. Right? All the technical analysis is about learning what probability is there for this to happen, not a confirmed. There's nothing confirmed in technical analysis. Nobody can do that. Right? So range for the next week is 19,000, 20,000, 44,000 to 46,500 for the Nifty and Banknifty. So 19,000 and 44,000, as long as that is maintained, the views that market could continue. If that is breach, then we have to think twice towards that. So overnight hedges has to be taken off to having positions overnight. Right? You can go for vertical spreads, no direction strategies and all of these, but the advantage there is that you have your risk defined. You can less capital you can use, since it's hedged, you can take larger positions and then still you can have defined risk and you will not wipe out the capital. Right? You know what you will lose. And also this option strategy can be used for investing also. There is a pullback you can buy, or you can get regular incomes by having option strategies. If you're not seeing all these different strategies for investing, rental income, then you can use regular incomes in the stocks. Right? Check out the playlist. We have a lot of videos on that strategies playlist you can check out. Right? That's it. Play safe. Be cautious. Market is has hit a all-time high, multiple all-time highs in the top and the reverse. Now all you have to look out is how far this retracement is going to go, and then market could behave well because we are very close to all-time highs. Right? So be cautious and position size properly as per how granular intraday volatility is still there. So play safe if it is intraday. Positionally also, position size as per your risk appetite. Right? Portion sizing and risk managing is all that's in our hand. Rest of the technical analysis is all about studying probabilities. Right? That's all. Thanks for watching. Happy trading, happy learning. If you're not subscribed to any of these social media channels below, Twitter, I have regular technical analysis and then charts and patterns posted regularly, so don't miss out on that. Subscribe to all of this, and then if you want to subscribe to Telegram channel, paid subscriptions also, you can do that. If you're interested, if you're not subscribed to this video that you're watching right now, and subscribe right away and then share to your friends. We have very few subscriptions. Put in your likes and comments if you feel so. We have very few subscriptions, as I said again. So appreciate your help. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.